Okay, so let's say you want to start a perfume brand, perfume manufacturing brand, or a perfume online store. Then how would you create the financial model for it? So basically, let's say the name of the business is XYZ perfume brand. You put the name in here, and it's going to be updated across all the sheets automatically. You don't have to write the name everywhere. Also, if you change the number of if you change the projection years in here, it's going to change the projection years across all the sheets and everything. So I'm not going to go into the basic stuff, so I'm going to take a dive into the actual thing in here. So let's say if you are starting the perfume brand and you have just $150,000 in savings, and you are not taking a loan, then make the loan zero and make this 150,000. And please make sure that you only enter investment figures or any figures in the cream colored or the pink colored cells, nowhere else, and only in the assumptions tabs. We have mentioned assumptions. So these are the assumptions tabs. Rest are reports. I'm going to get into the details later on. Let's start with the capex first. So let's say you start with 150,000. So you're not going to invest any more money throughout the years. You can invest, let's say in the second year, you might invest 50,000, 60,000, depending on the business, or you might choose to just reinvest the profit that has been generated from this business every time. So we're gonna discuss about everything in details. So if you invest 150,000, and let's say you are not going to set up your own machineries, you're not going to set up your own stuff to produce the product. You are just gonna source the product from a vendor, put the product in a bottle, and just start selling it online. So how do you do that? So in that case, you don't have to spend on these machines. We have already put in some machines in here. Please keep in mind that this is for perfume business, but let's say if you want to start a different sort of a business, uh, let's say you have a consumer electronics manufacturing business, then you can enter the machines required for that particular business in this area, and then complete the model. The capex part of the model is divided into two sections: the fund injection section, the capital expenditure section. And the capital expenditure has two types of items. One is capacity dependent items, and another is non-capacity dependent items. I'm giving you an example of perfume manufacturing, but you can use this for any manufacturing or any sort of trading businesses. I'm going to show you how to do that in clear details. So for perfume, the capacity depends on the production in terms of milliliters. If you are selling consumer electronics, it usually depends on number of items. Let's say if you're selling some sort of tea or some sort of wellness items, then it's gonna also depend on number of items. So for perfume, or let's say if you are selling liquor, or let's say cocktail or any other thing, it's also going to depend on milliliters for the production. So the capacity, this is the production capacity, and through these machines, you can see the 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 capacity, the capacity of the machines, and this is the production. This is the production in milliliters. So let's say this is negative. The reason this is negative is because your investment does not support the business. As you can see, it's red. I'm gonna dig into this later, but as I was saying, I'm gonna make this positive later on. But as I was saying, if you want to start a business without investing on any machines, then just make this zero. You don't have to do anything else, because you're not spending on the machines. You are just gonna trade the product. You're gonna buy the product and sell the product through your e-commerce store or through Amazon or whatever. So just make the investment on machines zero. It's gonna free up a lot of cash. As you can see, it has already become positive, because if you don't spend on machinery, if you don't spend on machineries, then you don't need a lot of investment. Machineries are required if you have a long-term plan, or if you have already established a brand and you want to take control of the supply chain. by through vertical integration and reduce cost. In those cases, you need a manufacturing setup. uh, for the time being, let's say you don't want that. So how do you set up this business? So I'm going to show this in a step-by-step manner. So in order to set up the business, we have certain items in here. For example, logistics management software, office space improvements. Let's say if you sell through a website, then you might put in here web development, then app development. If you are using Shopify, you don't need a website or an app, then you can just keep this. You don't need to spend on website or app in that case. In that case, the Shopify expense, let's say if you're paying $40 a month to Shopify or $50 a month, then 15 to 12 is $600. So $600 is gonna go into operating expenses. I'm gonna come into this later. But let's say if you are developing an app, then you have to put the number in here. We have made this zero. Logistics and management software, let's say you need a logistics and management software and you are spending $500 per year on that, then you can just put it in here. Whatever the amount is, it totally depends on your situation. That's why we have basically made this customizable. Office space, let's say you have an office and you have to improve that office space, 5,000. For the second third year, it's zero because you won't be spending on those. This is also the case for logistics and management software. If you have to pay it every year, then it's best to not enter it in the capex item. Then it becomes an expense. If you have to just pay it once and it gives you value over time, then you should put it in the capex item. For example, office space improvement, you won't have to spend regularly on office space improvements. If you just start the business, you have to uh, pay that amount initially and you can just keep on going for years. Same for web development. Initially, once you, let's say, spend $5,000, you won't have to pay every year. Maybe next year, if you want to add new features, then maybe $1,000, then $1,000. So maybe for the improvements, you might pay $1,000 or $2,000 depending on your situation. The same goes for app development. Let's say it costs 7,000. Next year, you want to add new features, you can just put in 1,500. Let's make this let's so after this you might want to spend some on legal expenses for company setup. Legal, maybe 500, and let's make this zero. As you can see, once you free up cash from your capital expenditure, you have more cash left for your working capital, which helps you grow the business by investing more on marketing and sales. So this is how the model helps you find out how much you should be spending on each of the areas to increase your chances of success without investing a lot of money first into the business. It helps you basically analyze everything, and it provides a bird's eye view of the whole situation, which is very helpful. So this can be zero. I can make this zero, or I can just make this miscellaneous items. So this could be like $1,500, 500. So in spite of this we have a negative working capital by the third year. So by the third year, the business becomes unsustainable. We're going to explain why and how to basically fix this. The business can become unsustainable for a bunch of reasons. One of the reason could be your product is not profitable. The second reason is that your product is profitable, but you are spending a lot of money on unnecessary expenses. The third reason could be your investment figure is not sufficient. For example, if you had invested 5,000, this would not have covered the capex expenses. Forget about the other expenses such as operating expenses and the cost of goods sold expenses. So these are the factors that are very important in order to make the business sustainable. So I'm going to discuss why this has become negative in the third year and how to fix this. But I need to do something first. So if an item does not have a lifetime, for example, web development websites don't have a lifetime. But if you are investing on office space improvements, you are buying equipment, office equipment, and those sort of stuff, then it will have a lifetime of maybe 10 years. Logistics and management software, maybe it can have a lifetime or usually it doesn't. So just keep it empty. I'll keep this empty. legally empty because it doesn't have a lifetime. Once you spend it, you keep on reaping the benefits over time. This also doesn't have a timeline. So after this, what I'm going to do is, so after this, I'm going to move on to revenue assumptions. This is revenue assumptions. So after capex, we move on to revenue assumptions. In revenue assumptions, we have to assume how much we are going to be spending on marketing, because if you want to acquire customers, you obviously need to be spending on marketing. You might get some customers organically. Let's say your friends are buying or your family members are buying. We also have space for that in here. Number of organic customers acquired, let's say 50, 60, 70, 80, whatever that number is. You might not have to spend any money for acquiring a particular number of customers, so you can accommodate that in here. But for majority of the customers, you have to spend money to acquire them through maybe Facebook marketing, through maybe Google ads, through creating content on your website. So this sort of stuff we have to consider. So this money, the promotional budget, has to come from the working capital. So if you are investing 150,000 on the business, XYZ amount goes to this, and after spending, you are left with 130,500 dollars worth of cash in your hand of working capital. So this through this working capital, out of this working capital, if you're investing, let's say 1% on promotional budget, then it becomes 1305. 1% is a bit unrealistic, so let's make this 5% or maybe 7%. In the first year, you might want to invest more to build brand awareness, to get more customers, this sort of stuff. The idea overall is that over time, the business should generate enough cash to automatically be able to increase the promotional budget, so that you don't have to worry about putting money from your own pocket. The business should pay for itself. That's the whole idea. Now, if you're investing $9,000 on the promotional budget for this business in the first year, and let's say through website and content, you are investing 457. So how did we come up with this 457? So out of this 9135, we multiplied this with 5% and we got this number, $457. So let's say you are spending $457 on website and content, and you get 46 customers from this particular channel. Then 457 by 46 gives us 10. Or in another way, we can say that 457 by 10 gives us 46. The customer acquisition cost is a assumed figure. The CAC, which is the assumed figure, it totally depends on your business, your location, the industry you're operating in, and a whole host of other factors. You can increase this number depending on your real life experience. If you're running ads, and if you see that after spending $5,000, you are getting, let's say, 100 customers, then the customer acquisition cost for each customer is going to be $50. So this is how we find the CAC, by real life experience. So this is a bit unrealistic, $10 of acquisition cost. So let's make it like 25 from website and content. Website and content usually has lower customer acquisition costs. It pays off very well usually, depending on our experience. So that's why we have put this as 25. From 7%, let's make this all of this 7%. So after that, what I'm going to do is social media. Let's make this like $40. So after spending $40 or $50, you're getting one customer. That's the whole idea. Google ads, let's make this $30 or $35. Email marketing, you can adjust these numbers as I mentioned, if you feel like it. Email marketing also pays off pretty well, so let's make this 25. In-person marketing, do you need in-person marketing? For if you are selling the product through online store, then you do not need an in-person marketing. So let's make this proportion of total budget 0, because we don't need this. But if you make this 0, you will run into a problem. That is, this will become below. You will run into a problem. This will not become the equal to 100%, because you have reduced the allocation for in-person marketing. So you need to increase the allocation for something else. This 12% has to go somewhere. Where should I put it? Let's put it here. So once you make this right, then it's gonna become 100%. Then it's not gonna show the error. Then what we have to do is, so we have in-person marketing set at 0. We don't have to bother about it. Customer referral program, let's make this 25. Others, let's make this 35. And let's say you want to use more promotional channels, so you can use them, and you cannot and you can also choose not to use them. It totally depends on your choice. So let's make this 0. Let's say I don't want to use this. Let's make this 0, 0, 0, 0, and 0. So we have 82% allocation. We still have to allocate additional 18% in here. So why do I allocate the additional 18% in the existing ones? So let's say I allocate instead of 5, I allocate 12 in here. How much are we left with? 11. So we have to allocate this 11 somewhere else. Let's say 22, and let's make this 20. Let's make this 24. Now it has become 100%. So this is how you play with the numbers and find out what to do with this. If you realize that this has become negative, which means the model is unsustainable from 2027, from the fourth year. So the current assumptions, the current customer acquisition costs make this unsustainable. If you lower the acquisition cost, for example, if I lower this to like 3, this will become positive, because if you have lower customer acquisition cost, the business becomes more profitable. So this is one of the beauty of this model. If you just create an Excel sheet by to calculate the profit of your product for your e-commerce brand, you will never be able to find this level of detail. And if you want to recreate this model, you would have to spend around 2,000, 3,000, or even more, and spend a lot of time building this. So we have this ready. So after this, as you can see, this has become unsustainable from the fourth year. So it's going to show up in the model. How do we fix this? This means that the amount of money we are charging is not enough, or the churn rate does not make the business sustainable. For example, what is the churn rate? So let's say if you are acquiring in total 287 customers in the first year. Out of the 287 customers, if you have a monthly churn rate of 2%, then you have a yearly churn rate of 24%, 2 into 12. So 24% churn rate multiplied by this many customers, which means 69 customers are leaving you. At the end of the day, 69 customers are leaving you if you have a 24% churn rate. So if you have lower churn rate, then your revenue, it's going to impact your revenue positively, because you have to, if you have less customers going away from you, and if you have more repeat customers, then it's a good thing for your business. So let's make this 1%. So if you make this 1%, as you can see, instantly this has become less negative. Before it was like this, now it's like this. Now let's make this 0.5%. So this is one of the ways to make the business profitable. There is another way to make the business profitable. There is another way to make the business by increasing the price, or by increasing the number of products sold per customer. So how do you do that? I'm going to discuss that in the revenue part. So far, the business does not seem to be sustainable under these particular circumstances. Now, you might think that since social media has higher CAC, so I'm not going to invest more on social media, and I'm going to invest more on website and content, or I'm going to invest more on website and content, email marketing, and customer referral program, because they have lower CACs, and which can impact my thing significantly. Or I'm going to lower my spending on social media and increase my spending on website. So you can basically play with the numbers, you can regulate this stuff, and basically find out what can make the business more profitable. So let's say I make this 10%, and the 12% goes to this particular area. Now, as you can see, this has become less negative. So these are some of the ways you can use. So let's make this 5%. Let's make this 29%. So the business will be unsustainable from 2028. So we have to find out how to make the business sustainable by fixing the revenue in terms of the pricing, the number of products sold, and the cost. So let's say instead of number of products sold to be 1, let's make it 2. So if you make it 2, instantly this changes. So you can see that the impact it has on your overall model. If you look at the model, you will be able to realize that I need to sell at least two products of $60 in order to make the business sustainable or profitable in the long term. If I make this one again, it's gonna be back to negative. So let's make it two. You can also increase the price. It totally depends on you, or lower the cost. So this has the price. This is very simply done. So you have uh, instead of perfume, if you're selling something else like a consumer electronics item, you could probably you could have a earbud in here, you could have a um, smartwatch in here, you could have this in here, that in here. So it totally depends on the item you have, but the model's fundamentals will not change. The model's fundamental will remain same. I'm just showing you with a perfume brand. You can do this with any sort of manufacturing or e-commerce brand in here. So after that, we have the COGS assumption. For COGS assumption, we have certain stuff in here. For example, if you are manufacturing the product, you will have to rely on multiple COGS items. But if you are, let's say, just buying the product and selling it through your e-commerce site, then you won't have to deal with a lot of items. For example, if you have a perfume brand, then you need to spend on essential oil, alcohol, colorants, fixatives in order to produce this. The proportion will basically depend on your operational plan and your recipe. As you can see, 12% essential oil, 84% alcohol, 1% colorant. So let's say if you had a smartwatch manufacturing facility, then you would be maybe spending um, 10% of the stuff 10% of the stuff in the glass, 1% of 15% on PCB, 1% on this, 1% on that. So you can adjust it accordingly. For the perfume brand, we have adjusted it in terms of volume ml per unit. For example, if you are selling one unit, we have assumed that one unit will be equal to 100 ml. Out of the 100 ml, 12% goes to essential oil, 84% goes to alcohol, 1% goes to colorant, and we have mentioned the price or the cost for each of the items in here. So you can adjust it accordingly. Let's say you don't have a manufacturing business. In that case, you don't have to basically bother about this. You can just make this zero in here, just make it zero. After making it zero, what you do is, let's say you just have packaging cost, others cost, and let's say the cost to buy the item. So let's say I buy the perfume bottle, each bottle for cost per item, let's say to be $5. On top of that, I have to pay for $2 for packaging and $1 maybe for fulfillment or other stuff. You can just put it in here. Make this zero, make this zero. Now look at the revenue assumptions at this moment. It has significantly improved. Earlier, before doing this, it wasn't so positive. So after reducing the cost, it has become significantly positive. So it totally depends on the pricing and the cost. For example, in here we have assumed that you are going to be selling this item, Blossom Euphoria, which is this item in terms of cost for $60. You're going to be selling this for $60, and you're going to be buying this for $5. On top of that, you're going to be spending $1 on others and $2 for packaging. If it was 7 or 12, then it will obviously impact the profitability negatively. We can do the same for the other stuff in here. For example, as we are assuming that we won't be manufacturing this item, so I'm just going to copy this, paste it here, paste it here, paste it for all the products, paste it for all the products. You can do the same. It's going to save a lot of time. After that, you can just bother about these particular items, these particular costs. So this one had 12, maybe you will have to buy this one, the second item, which is Aura Whispers, for maybe 7. Totally depends on your understanding with the supplier. maybe this one for 15, maybe this one for 12. So let's keep it 12. Let's keep the rest of the stuff 12. So this is how you can design the model so efficiently. So after this, as you can see, this has increased significantly, because if you have more cash, you can spend more on marketing, which in turn will get you more customers. So this is how this works. If you have a less profitable business, you will be able to spend less on marketing, which will adversely impact your customer acquisition. Okay, now we have operating expenditures. So what is the basic difference between operating expenditures and cost of goods sold as expenditures? So the basic difference is that cost of goods sold is variable and operating expenditure is fixed cost. Let me give you an example. For example, if you are spending if you are spending X amount of money on this particular item's cost of goods sold, then it will totally depend on the number of items you are selling. If you are selling 10 Blossom Euphoria, then you will have to spend 10 into 12 for COGS. So it is variable. It totally depends on your revenue. If your revenue increases, then the cost for this will also increase. But for fixed cost, let's say office rent, it is fixed. It is not proportionately dependent on your revenue. If your revenue increases or decreases, it doesn't affect the office rent. It's going to be same. Another one is your salaries. It is not proportionately dependent on your revenue. There are some stuff related to salaries, like wages for labor. If you have labor, which are dependent on revenue usually, but for most part, salaries is not directly proportional to revenue. So what sort of stuff we can put in here? If you are kind of stuck and you can't seem to understand what to do, you can take help from ChatGPT also. So let's go to ChatGPT. You can use the free version or the paid version of ChatGPT. Totally depends on you. So for here, let's say I'm going to use the free version. Give me OPEX items for my perfume brand, which I am selling through my online store. So as you can see, we have website hosting fees, e-commerce platform fees, payment processing fees, this sort of stuff. But payment processing fees is not part of OPEX, because it totally depends on your it totally depends on your revenue. If your revenue increases, then you have to pay more to Stripe or other payment processors. So ChatGPT makes mistakes. Please only include fixed expenses. Payment processing fee is not operating expenses. So I can mention website hosting fees. Then we have inventory management, software subscription. Then we can have insurance premiums, and the rest of the stuff we can keep empty. uh, let's make it 0. And now let's make this more realistic. Let's say office rent per year is, let's say, if you're, let's say, paying 5,000, then it's going to cost you maybe 60,000 per year. So let's make it 50,000. Initially you won't be wanting to spend a lot on office rent, so let's keep it low. Let's keep it like 15,000. Or you might not have an office at all. It totally depends on your choices. You can adjust the model as you like. You don't have to bother about anything. If you are taking a decent web hosting plan, then you might be spending maybe 2,000 or 1,500 per year. Inventory management software is maybe 600 per year. Insurance premium maybe 2,000 per year. It totally depends on the business model and your choices. These figures are absolutely customizable. If you have a tax rate of like 10%, then just put it in here. then it's gonna adjust accordingly. After this, we have the cash flow assumptions and the salaries assumptions. I'm coming to the cash flow assumptions later. Let's focus on the salaries assumptions first. Okay, now let's focus on salaries assumptions. So let's say you're the founder. Obviously, there will be one in here. If you have like 2 or 3 founders, then you can just change the numbers in here. And let's say you pay yourself 2,000 every month, or maybe 15,000 every month. It totally depends on your choice. Then it's going to adjust accordingly, and you increase your pay annually by 2%. Then you are paying this much salaries every year to yourself. This is monthly salaries. Please keep in mind, not yearly salaries. This is going to impact the total salaries, which you can navigate to this particular point in here. So if I just visit here, you will realize that the monthly salaries is converted to yearly salaries in here. So 15,000, you can increase or reduce this based on the profitability of the business and the overall situation. Let's say you want to keep a CFO from the third year. Then just mention one in here, one in here, one in here, and it's going to adjust automatically. You don't have to do anything else. Uh, for CMO, let's say if you want a CMO from the second year onwards, or chief marketing officer, then you can just keep in here, put them in here. So this is the way we adjust these numbers. For production and operations, let's say you need someone for fulfillment, fulfillment in charge. So fulfillment in charge. So you are, let's say, paying that person 1,500 per month. From the third year, maybe you need 3. So you can just put 3 in here. If your business supports it, then you can keep them. If your business doesn't support it, you can't keep them. So the way you can look at this is go to table of contents, go to income statement, and just look at the numbers in here. For example, after, as you can see, after putting so much money in salaries, your business is running into losses in here, into net loss, as it's negative. So we have to reduce our salaries expenditure. So this is how you can find out if you will be able to afford one person, if you will be able to afford recruiting a person in your business or not. So for the time being, let's say we want to keep it lean and we don't want to take a lot of money from here. So we are going to reduce the salaries. We are just going to keep the important stuff. Maybe we don't need a CFO. Maybe we can use someone from Upwork to basically do bookkeeping for us. Maybe we don't need a CMO. Just keep it, make it 0. Maybe we don't need a COO. Let's keep the CO. Customer service representative. Maybe you recruit people from Philippines in order to cut your cost for customer service representative. Maybe you keep 3, maybe you keep 5, 5, 5, 5, and you pay them maybe $300 a month. Then it's going to significantly reduce your cost. So this is how we basically adjust these numbers in here. Let's make this 0. As you won't be putting any positions in here. You can put the positions in here. It totally depends on your choice. Let's say if you have an existing perfume business, you can just play with the numbers in here and see if your business can sustain an expansion plan with a particular amount of investment. You can also use this model for that. So let's make it 0. Let's make it 0. Let's keep someone for digital marketing executive, content, SEO specialist. Okay, so maybe you pay that, you get them from somewhere uh, on Philippines, through Philippines or through other countries, and keep the cost low. Maybe one person dealing with this. Content SEO, let's say you hire an agency and you pay them like 7.99 a month. So you can just put it in here like this. For finance, for bookkeeping, let's say you hire someone from Upwork and you pay them like 250 to do your accounts, let's say 1%. And let's say you don't increase their annual salaries. So this is how it works. Now let's look at the income statement again. So now as I look at the income statement, as you can see, the first year we're going to run into losses. From the third year onwards, we're going to start generating profit if you spend like this. Now if you spend more or less on promotions, on salaries, on other stuff, then it's going to obviously impact the profitability. It totally depends on your game plan, nothing else. Now let's get back to the cash flow assumptions tab. So let's get back to cash flow assumptions. So if I look at cash flow assumptions, it's divided into three sections. One is payables, one is receivables, and one is inventory. So in here, we have mentioned salaries, payables, but you can just remove this to payables to suppliers. So let's say you take the products from your suppliers and you take like 1 month to pay them back or 2 months to pay them back. So if you take 2 months to pay them back, you will have more cash in your hand, which is good for you. And receivables is how much time it takes for you to get the money from your customers. Let's say it takes 1 month or maybe 0.25 months, which means 1 week. So you can adjust it accordingly. So it's best if this is low, because if it takes less time for your customers to pay back to you, then you will have more cash. If it takes more time for your customers to pay back, then it's gonna reduce your cash. Same goes for inventory. If you need to keep more inventory, let's say instead of 1 month you have 2 months of inventory, then you need to keep more inventory in your stock. Let's say it takes at least 4 months for the products to be shipped, or 3 months for the product to be shipped from your supplier's factory to your particular warehouse or your fulfillment center or your third party's fulfillment center, then obviously you need to keep more inventory in order to avoid stock out. So if you have to keep more inventory, you will have a lot of cash stuck in that inventory. So this thing is going to determine how much cash you have from your payables, from your receivables, and your inventory. Higher receivables and higher inventory is bad for business, and higher payables is good for business. Always remember that. So based on this, if I look at the cash flow right now, this is 72,490. Just keep this in mind. Now let's get back to cash flow. So let's increase let's increase the payables to like 5 months. Now let's see what happens. As you can see, the cash has increased significantly. If you pay your suppliers, if you take a long time to pay back your suppliers, then it's really good for you. It's interest-free loan. So it will help you expand your business significantly. So this is how the model is going to help you find out how much you can expand the business, how much how long of payback period you need from your suppliers, what sort of terms you need to set up with your suppliers. So this sort of stuff you can basically play with the number. This sort of stuff you can figure out with this model. So the income statement I have already shown. This is some summarization of everything we have done so far. Then we have cash flow and the balance sheet. Now after this, I'm going to show you how to write the business plan from this particular financial model. So the reason for starting the financial model is if you want to write a business plan, you should start with the financial model, which will help you create the overall structure and the skeleton or the chassis of your overall business plan, of your overall business model or your overall projections. So this is why we started with the financial model. Next, we are going to start writing the business plan on this perfume brand.